Hello traders, Gary Wagner here just after 10 o'clock in Honolulu, 4 o'clock in New York on Thursday, 19th day of December 2013. And this is the daily report for gold and silver. Yesterday, the Fed begins their process of tapering, or the announcement came out that they began their process of tapering. Tapering, not canceling. They're simply going to reduce the $85 billion to $75 billion. They also stated that they plan to keep interest rates low. The net result has been severe pressure as the precious metals really break through levels of critical support and I believe are headed lower to the board. We currently have gold trading off roughly $23 on the day, $11.94 and change. The low, $11.92.30. We're just off of the lows, and the highs, we won't see them again this year at $12.25.70. Silver also under really strong pressure, actually trading off about 2.5% on the day, 50 cents lower, 19.23, the low 19.06, and the high 19.74. We'll cover silver a little bit towards the end of the show. You know, there's no question. We have been calling for lower pricing in the precious metals markets for quite some time now. I've also talked about the fact that I really thought that it would go and retest the 1181 low. Now we've gotten to 92. We've not quite gotten to that low of 81. But we have broken through really what I believe to be pretty critical support. We had two different support lines, just as we had on the top that we had on the bottom. You can see some support right in this area and some support right in here. Our secondary support was that low, and that was 12.11. Well, proverbial hot knife through butter, so to speak. This market came down. It came down with a vengeance. When you consider the range over the last two trading days, you're looking at 42 to 95, almost a $50 or $50 plus price swing in just the last day and a half. Tremendous downside action in the precious metals markets. And on today's show, I'll try to give us a sense or a feel for where we think it's going. But to be clear, my sense right now is it will go and retest at least 1181, and I believe that it could easily make a new low. We'll talk about that in a second. On today's show, I do want to talk to you about an observation that I've been looking at in terms of direct correlations in the equities markets, the gold markets, and quantitative easing going back to about 2003. We'll take a look at that in a second. But for now, this is a 720-minute chart, short-term chart, half-day candles. The reason I want to look at that is this is the low that we are now threatening to take out. We're really pretty close to it. 1181. And this is when the market came down from 1800. This is that last of that series of tops we had at 1800. Market comes down strong and hard and then forms this low. The only really rally that we had in 2013 was exactly what followed this low, because we watched it go from 1181 up to about 1435. That's the only significant rally that we saw the entire year, calendar year of 2013. So we are now at the end of the year really threatening to give that back as we quickly approach that particular low. Now in terms of our Elliott wave count, we are looking to see whether this low holds and we get that bear truncated fifth wave, or if it makes a lower low, which I believe at this point is probably more likely and has a higher probability of unfolding. I've just been finishing up the final production for our Outlook 2014. Of course, I will send you, our subscribers, a link prior to anyone else seeing it. But an interesting observation as I was looking at the equities markets, quantitative easing, and the gold market over time. And what I found is pretty interesting, and the main reason that we even began to look at it is when we look at the calendar year 2013, and that's what is boxed in purple or blue, we've had a runaway stock market to the upside. At the same time, we've had pretty much a one-direction downtrend in gold. We had an absolute divergence of equities moving up and gold moving down. But interestingly enough, with quantitative easing, it hasn't always been that way. We are currently trading on the lows at 1193 and 1192, by the way. But here's what I found interesting. The stock market itself was a runaway stock market through 2003 up to about 2008, and of course then we had that crisis, and we had basically the market crash, in which it came from 1600, lost over half of its value as it came down, and we began quantitative easing. Quantitative easing started really at the end of 2009, and if we simply draw a line across so we can see how it affected the markets, you didn't get an immediate effect in the equities markets. Equities markets did continue to trade lower for a little bit. However, by the first part of 2009, it really began to take off and really start to move in this upward spiral. At the same time, you had equities moving higher and you had gold moving higher. So they were really moving in tandem throughout 2009, 2010, and in 2010, the end of 2010, they started what was called QE2, quantitative easing 2. And we continued to see the market rise. In fact, that created the record top that we got in the stock market. And at the same time, we had equities running higher. They didn't reach a new top, but as you can see, they ran higher. Now, we had a sell-off in the equities markets, and at the same time, this is when gold broke from 1900 plus and began to trade lower. It comes down to about 1535, so it gives up quite a bit. But that's really where we begin to see a divergence in the market, because what we witnessed after that was a consolidated trading range in which gold would oscillate in between 1800 on the top and about 1535 on the bottom. As you can see, really what we noticed was the market really trading within that range back and forth, and we had a series of tops. First top, second top here, and then our triple top, or the third top here. At the same time, the stock market recouped, and it actually began to move up and move higher, and then most recently we had our QE3, quantitative easing 3, and that was the announcement that they would do monthly purchases. Prior to that, they were doing these big bulk purchases, I believe, with QE1 and QE2. They would accumulate the billions of dollars in assets, but here they decided, they started at 40 billion, and then at the beginning of 2013, they went from 40 billion to 85 billion in terms of monthly purchases. Interestingly enough, the onset of QE3 is really the demise of gold, because as that market, the equities markets, continues to rise to new record tops, after quantitative easing and QE3 is actually implemented, that is when we really get this dramatic drop in gold prices. What do we make of it? Well, I'm not really sure yet, but I find that it is interesting that on the onset of QE3 was really the end of any kind of a bull run in gold, because that's when we really saw it come down. Now, why is that important to us now? As far as I'm concerned, it's important for one primary reason. Because yesterday we announced the beginning of tapering. It's going to be another little arrow. And is that tapering then going to affect gold to bring it to new lows, or is it going to have almost the opposite effect? Because here, where we have quantitative easing QE3 beginning, we really have the end of the gold bull run as they implemented that program. So it's interesting in that what could have been construed as a bullish factor for gold really brought the price down. I thought it was absolutely worth noting. We'll have more of this as we complete our outlook, and then I will present our findings to you first and to the general public again next week. So that brings us to our current market observations. As you can see, we are on the lows, 1191.80. My personal sense is we will absolutely go and touch at least 1181, but my real concern is that if we have basically a standard fifth wave, meaning wave 3, wave 4, wave 5 will have a new low, it could in fact take us to 1154, and then below that is 1042. Those are going to be the new targets that we want to look at. My sense is even if we get that truncated flat, we could in fact go and see a new low anywhere between 1154 and call it 1181. That's the current low. We're only $10 off of that. However, if it breaks through that particular area, the area that I would look for to see how it react would be between, as I said, 1154 and 1181. If it breaks below that, I would look for 1042. So what are my numbers for silver in relation to gold if in fact we see continued pressure? Daily chart, I've highly compressed it because the lows that we really need to take a look at right now, if in fact it continues to break down, my sense is it's going to head to $18. I've been talking about that for quite some time now, the low $18. But if it cannot hold that, just as if gold doesn't hold 1154, the next real target or area has got to be really right at 18 to a little bit below 18, as you can see by this particular bottom in the market. Now, absolute support right now has been broken because my sense was that our number at around 1958 was an area that needed to be held. Technically, I was looking at this area where it was resistance. It should then become support. We have this area that is below our support. Even though it came back up, these lows right in here is really where I believe we could see silver move to if in fact we see a continuation in this sell-off in gold. As I said, it's roughly $10 away from the low right now at 1191, and my sense is it absolutely will at least test 1181. We'll see how it reacts. 1154 is my next number after that. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.